I didn't have, like many people who've got some money to invest. It took probably about 4 or 5 years before the exit. I started to put in way too much money in follow-on opportunities. This is company working on something that I find personally really worth solving. Who is going to pay for these big machines? Are you able to find a lot of alternative sources of finance? They play a different game, but the next level of investors like the same.
Hello, everyone. Welcome back to Investor Returns. I'm Uljana Steibel, and in this podcast, we dive deep into the world of venture capital and angel investing. Every episode, we bring you insights, strategies, and real stories from a top investor shaping the future. Today, I'm joined by Jan Paul van Driel, and Jan Paul is experienced angel investor and a founder of StrategicFit, a strategy consultancy. Jan Paul has a science and engineer background. He worked internationally for over 10 years and then settled for a consultancy. Later founded three companies, of which he exited two and become angel investors about 20 years ago. So currently, Paul has over 50 investments and is on a board of five companies. So let's dive into exciting discussion. Jean Paul, I welcome you to our podcast. Really looking forward to have your insights and your story shared with our audience.
Thanks, Oyana. Thanks for having me.
Yeah, I would like just uh, ask you really how you started angel investing. What was your story before, and what inspired you to become angel investor?
A friend of mine started a company. He was based out of the US. Uh, I had a very high opinion of him. I still have, and he asked me to join the investor group, which I did, and it was very successful. So it took probably about 4 or 5 years before the exit. But that was my first experience with angel investing. So it was a friend. It was an interesting idea. I immediately could see the benefit of that, and it was very successful. And it gave me a little bit of a false perception of how easy angel investing was. So it did set me up for failure later on. But it was a real success story the first time around.
So it was actually your first investment before the exit. How many of the companies you had before you saw your
Well,
first
this is
exit?
but my own. This wasn't my own company. This was just an exit for an investment. But at the time, it was short. It was briefly before I started my own first company.
Yeah, and was it actually quite deep tech investment that you did at first? Something close to what your background in engineering and I think you've been doing the consultancy in the energy sector. Was it somehow related to your area of expertise, or was it more like totally another thing that you were?
Totally another thing. It was in the field of life sciences, and it had to do with automating something that was very inefficient in practice. It's the detailing of doctor views of products. That was the area. Nice idea, neat idea, and it really worked well. So I thought this is really easy.
Okay, amazing. So it actually sounds that you've been really very much inspired to continue your angel investing journey. Have you approached actually looking and finding a next investment opportunities? Was there any strategy how you were sourcing in deal flow? Any groups that you were joining to source a deal flow? What was your actually behavior back in the day to get those opportunities?
Yeah, I didn't have, like many people who've got some money to invest. Um, that is because you've got a day job and you work really hard at it. So I didn't really spend as much time on getting the right deals, and it was more opportunistic. So if things came to me, I would look at it. I would very often join one or two individuals that I knew from my network, and then essentially follow them. That was my initial strategy. So opportunistic, not through angel syndicate rooms, and not feeling that there's an enormous amount of investment opportunities out there, a little bit scarce in terms of opportunities, and the behavior, and because I had this sort of false sense of capability, I I made the rookie mistake of going in at too high a level of ticket prices. So that's how it all started, and I started to put in way too much money in follow-on opportunities.
What was actually your largest ticket?
I don't I don't really want to say. It's way too much. Way
So
too much.
no, let's ask me like this then. What amount of money would you suggest to other investors to put in early stage investment opportunities?
So what would be sensible, you mean? Yeah, so it depends a little bit on how much you've got to spend and how much you're willing uh, to put into risky investments that take forever to give a return. So whatever money you put in, don't count on it ever coming back, and it's going to take about, realistically, about 10 years. So these are really long-term type of savings, and you've got to have the appetite to put it into very uncertain outcomes. So my view now, after these 50, let's say after 10, 15 years of experience, the penny dropped, and it's far better to have a ticket size that is, let's say this is the way to probably do it. If you have, call it 100, doesn't matter what 100 it is, but call it 100. So you're willing to invest 100 in a year, put it into something like 4 investments, and that would be the size that I think is appropriate to enter into each one of these investments. So if that 100 is $100, then that wouldn't be moving you very far. But whatever the unit is, so put it in 4 investments and make sure that you can do that year after year. I think that would be a really sensible strategy in terms of how much you want to invest in how many companies.
So basically, diversify rather than put all eggs in one basket, right?
Yeah, and there's a couple of reasons for it. I think the biggest advantage of doing it that way is that that if things go well, you really learn the company. You get confidence in the founders, in how they communicate with you. You get more confidence in the fact that they're on a roadmap that really leads to success, and you can really follow on with further investments. So it's not so much in placing a bet and then see after years whether it's going to be successful, but it's much more like a journey that you can the first entry gives you a ticket to further invest. It gives you the right to then participate in further investments. I think that's really quite powerful, and not every angel investor does it that way.
Yeah, exactly. Sounds like a very reasonable approach. Kind of the way of de-risking it. Everyone having its own way have to de-risk it, but it's probably the most important, really, to have some way of de-risking it. So yeah, and what is actually your current investment thesis? Do you hunt for specific industries, specific business models, specific type of founders? Because over 50 investments and over 20 years of actually being in this investment journey, so definitely you already have some understanding what it takes to build a good company. So what is your secret sauces?
Yeah, well, it's been a bit of a random journey initially, but what it ended up for me is I'm looking for opportunity. First of all, big question is this a problem that's really worth solving? Is this company working on something that I find personally really worth solving? So it has a big impact on something that I find relevant and important. Secondly, I think I need to have some sort of an affinity with the founders. They need to be people that I like to see being successful. Not that I don't like anybody being not successful, but I really need to feel the need to make the founders successful in any way. And then finally, if I can be helpful in the journey, that would be a real good bonus.
I wanted actually to ask you about like how your experience of exiting companies, right, impacted your way of decision making about investing in certain founders or certain business. Have you learned something special from your exits that you can now identify almost on a beginning of the any company journey?
Yeah, it's an interesting question. I think um, I, I have a sense for I can have a sense for a number of companies that it's going to be really really hard for them to exit. So in terms of a filter on thinking, well, this is a little bit too much like a lifestyle business. It's going to be very hard to exit a business. So the whole exit journey is pretty painful, in particular for founders. And you've got to be in a very strong position as a company to be able to go through that journey in a good way. So first of all, you don't need to depend on an exit because otherwise it's going to be not particularly attractive. Um, and you need to have a lot of choices. So need to be a number of buyers who are keen to buy you. Uh, there are, of course, exceptions where company is just really lucky and it fits in with a strategic acquisition by a large company, whatever it is. But I can see a number of conditions that if they are not being met, I'm not going to participate in the investment itself. Uh, but the reverse is not true. It's not like this is the secret sauce. If these conditions are met, it's certainly going to be an exit. That's just not going to be the case.
Yeah, timing matters a lot, right? A lot of the things may look well, but in the end of the day, if timing is wrong or just maybe luck, do you believe there is some in some way a kind of the luck measure, for company success?
Absolutely. And I think if you're a successful founder who've exited their business, um, sometimes it's a little hard to recognize how lucky you've been. But it requires a lot of luck along the way. So capability, a lot of founders are highly capable people and ought to be successful, but very few actually are successful.
Yeah, so hunting for those who can, and actually, yeah, a little bit relying on the luck that that all the circumstances will be around those founders to complete their mission and to provide angels with a good exit. Do you diversify your portfolio from in different asset classes? Have you ever had your portfolio, let's say, in real estate, stock markets, or you only been investing in venture capital?
So obviously, if you are investing in early stage startups, you have absolutely no visibility when you get your money back. So you've got to have the liquidity to be able to make those investments. So I guess first of all, if you've got your house that you can live in, if you've got enough savings, if you've got a pension build up, after that everything becomes discretionary. So some people out of that discretionary pot, some people then allocate a small percentage to startups, risky investments, and then a lot of other things into very safe investments. I put everything into early stage. So, but you know, I don't fully depend on good outcomes. It's I've already got a base that makes us comfortable. But the idea behind it is that ultimately, if you don't make too many mistakes, the returns are going to be pretty attractive. Not super attractive. Don't fool yourself. If you're very lucky, they're going to be super attractive. But you know, just being realistic, it's a pretty good investment. But it's just very volatile. It's very unclear when things come in. It's very unclear which one of your investments is going to be a good one and which one just fails. It's a bit of potluck involved in that.
Out of your portfolio, do you have more of those exits after the first one, or you still in this period of waiting for the exits to happen?
Yeah, no, fortunately, I had a couple of other exits. So essentially, what it boils down to, it the first 10 years, except for the very first investment, the first 10 years is basically money out. Second 10 years, as much money comes in as it goes out, and then I'm now at the third 10 years, and hopefully, there's more money coming in than going out. So that's essentially what it is. But it just takes a long time.
And those exits which are happening, do you see right now a trend like companies are doing actually M&As or IPOs? Like where they exiting, or do you actually exiting to secondary funds? You know, when the fund buy out the early stage investors because they want to be part of the late stage company.
Yeah, so it's I mean, IPOs is very rare. You've got to be I guess you have to be very lucky to be part of a journey that leads to an IPO. Most of my exits are companies that strategic acquisitions that buy companies, or alternatively private equity firm that buys. In my case, just now I'm going through a process where they've bought part of an investment that I made. So it's a mixture, but it's not quite like 10 years ago. 10 years ago, it was the returns were much higher, much quicker than they are now. It's a tougher market out there, and hopefully, and the quality of the businesses. If you've got a high quality business, there will be people who are interested in it. But if you have a business that just that isn't quite high quality, I don't think it's gonna work out unless you're extremely lucky.
Actually, to that point, like, how often do you see startups who pivoted eventually end up doing the exit, or you see more of the startups who actually stick to their initial idea, who become later on successful? Just out of your portfolio and exits that you did, do you see some kind of the correlation between pivot and exit?
Well, I mean, almost all companies pivot in some way, shape, or form. If you're early stage, a lot of so for instance, the technology is clearly interesting in a number of areas, and exactly which area they're going to be successful, and exactly in what sort of business model is being applied. are variables, so they have to adjust and pivot to some extent, all of them. So I think that's a key metric for founders. If a founder is very open-minded and understands what's happening and can recognize what works and what doesn't work, those founders will make the right decisions along the way. As one company that is now at the stage that's pretty mature, and up to now the journey was actually pretty simple, but because they have been successful, they suddenly have so many more opportunities in terms of making their own acquisitions, in terms of which geographies are they going to focus on. So in a way it becomes a much more complicated game where I think they'll still have to respond and react to what's provided to them. So I think pivoting is quite a normal thing in along the journey.
Yeah, it's probably very rare beast. Those startups who can just get it right straight from a beginning. For many, it is definitely a journey, and persistent capabilities of the founders would define this journey being successful or not successful. I think you mentioned to me in our previous conversations about you remember those components which allow us to build the angel investing, like which really allow to build the ecosystem, right, of angel investing in a country.
Mhm.
So can you probably summarize for me, like, what do you think it takes to build the successful angel investment portfolio for yourself, and also what it takes, or what do you say would actually help to build the ecosystem of angel investing, VC investing in a country, right?
Yeah. So in the UK, so I invest most of it in the UK, but I've got investments in the Netherlands, in Denmark, in the US, and each one of these areas is quite different. So I think in the UK they've done very well with EIS and SEIS schemes. So it's very attractive for people to make these early stage investments. You have to qualify for especially SEIS. You've got to be a very young company, 3 years. So they genuinely are very risky, very early stage type of investment opportunities. Now, I think the syndicates the syndicates work really well as well in the UK. So I'm not quite sure how many syndicates there are, but there must be hundreds. I'm a member of 4 syndicates, and it gives you a very good lead stream of opportunities. Especially since COVID, everything is online, so it's a pretty effective way of getting a view into a large number of opportunities, and you join with a number of people who are interested in particular opportunities to do due diligence jointly. I think that's really powerful as well. So that's the angel side of it. And I think as angels, you typically come in earlier. The VCs sort of have a look in at that stage. But if you're competing with VCs, that's where it starts getting a little bit more difficult as angel investors. But as part of a syndicate, at least also your ticket size becomes pretty significant in a round, and sometimes you lead the round. But at least you've got quite a lot of sway in the discussions around the term sheet and getting having leverage in a company after your investment. So I think that part of the infrastructure works really well. Of course, VCs, when they come in, they've got much more money, they've got much more power. When they come in, they want to set the terms that are really attractive for them. And if they have their say as an angel investor, you generally come out worse. So the terms are really good for them, much less so for the early stage investors. Having said that, if you are an investor, you can follow on with your investment, and you've got a ticket to play on the same terms as the VC comes in. So that's why that's one of the earlier lessons. If you put in too much of your powder in the very early stages and you haven't got anything to follow on, it's more of a bet and less of a journey. And I think ultimately, I feel my best investments have been, and my worst investments, by the way, my best investments have been follow-on investments. Sometimes you follow on because you're already somewhere and you throw good money after bad money, and that's a really bad idea. That's another rookie mistake that I've made in the beginning. But I think playing it that way um, gives you a ticket to continue and to benefit from the same terms as the VCs have at the later stage.
Yeah. So in very like short 3 words, what are the benefits of joining the investment group?
Learn from others and have more influence.
Yeah, exactly. We see it a lot when working with the syndicates as a quorum platform. So definitely gives a lot of leverage to invest as a group, larger allocations, better due diligence, better deal flow, and but I know you still continue to do the direct investments, right? And you told me that you're seeing nearly 30 pitches per month, right?
I think so. Yeah, but it's not too difficult if you're a member of a number of syndicates and you have a network. Then that's kind of the number that you see. But yeah, there's only a few that you can dive into and really do your homework on. So there's a lot of them that you have to discount very, very quickly. Otherwise, it's unworkable. Otherwise, I might as well be a full-time VC, and I have a day job.
So does it help actually when the angel syndicate provide you with investment memo? Because many angel syndicates would prepare this investment memo upfront of the founder pitching. Do you find
It's helpful. Yeah, it's helpful, and there's some key information that's there. So all of that is very helpful. But you've got to see the pitch. So first of all, you need to be sufficiently interested to want to see the pitch, and then you have to see the pitch to see whether you're actually genuinely interested or not. And sometimes, very often, after a pitch, I find it very difficult. I get enthused. They bring me into their opportunity. It's clear that they're capable people. It will be fantastic if that's successful. So you're being brought into a lot of these investments, and I just need to have a night's sleep, and then the next morning I wake up and think, no, this is just not for me. So that's how I go through making my decisions.
Okay, so you're not very much impacted by the group FOMO, the fear of missing out, or you do to some extent. Do you believe actually there is a FOMO?
Well, yeah, I mean it's well alive. So, but I try and not be impacted by that. That is a big mistake. So I think the biggest mistake that I made in the beginning is that I followed the lead too much of other people because I knew that they were more experienced than me. But you've got to really learn from what other people think and sort of allow them to challenge the biases that you have, but you've got to make your own decisions. And if you don't, you never learn, and you'll always regret what you've done.
Yeah, but this is also the benefit and the beauty of having 50 startups in your portfolio, because you definitely have this experience already to make your own mind and your own decisions. What about actually investing as a LP in a fund where you take a much more passive role? Were you like in the past? Was you ever considering to join as LP in a fund?
Yeah, I've never considered it. I've had the opportunity to do it a couple of times, of course, but so for me, the fun is to be part of the journey and to be very close to these startups. So if you're an LP, you're deprived of that. I also like to do my own due diligence and to make my own choices. As an LP, you're deprived of that. And finally, if you actually work out the amount of money that's being left behind or being taken by everybody that is around this whole uh, circus of people, there's a lot of money that goes away. So if your return, let's say you on average you've got something like 3x, 2x of your investments. Uh, that's much less if you're an LP and the fund makes 2 or 3x. So it makes a big difference.
Yeah. So do you filter out companies through the layer of them being a unicorn, the same way as VC funds do?
Yes, unicorns would be very nice. So I think you can hope, but that doesn't happen that often. But I certainly the 10x criteria, I certainly apply that too. If I don't see a route to 10x, then it's not going to be sensible to do this. And let me explain this not from a perspective of greed or return, but if you invest in something that's worth the while, that you find is a problem worth solving, it has to be successful uh, in that sort of order of magnitude to have any impact. So that's the way that you have to that I look at those sort of things. So so you aim very high for very high impact, and probably 1 in 10 or so make it to that level. And if I look at my portfolio, that's pretty much what I do. But if something has a return of 2x, you can't afford to take any risk. So it's a different type of investment. So some angel investors make sure that they don't lose any money, but they have to accept the fact that they invest in more mature companies at a higher valuation and ultimately at a much lower exit multiple. Um, I'm not saying that doesn't make sense. Probably does, but it's just a very different type of investment.
So you don't do late stage investing with less risk, but also lower returns. Um,
Not really. Sometimes, well, in a way, you do if you decide not to take a secondary. So if you have an opportunity for a secondary sale and you don't take it, automatically your mindset is, I'd like to. I think it makes a lot of sense to double my money over the next 2 or 3 years. So that's like a 2x. But yeah, if you calculate that on your initial investment, it's a lot more.
so
Uh,
you still do this kind of decisions when you have the opportunity to exit after waiting, let's say, 7 years, and you keep your money in the company because you believe there is going to be a larger exit.
Absolutely, you're part of a journey. But so at that time, if you haven't got a good relationship with the founders and you haven't really been part of it, I'll take the secondary. But if you're still part of, if you still communicate on a regular basis, and you're sort of emotionally connected with the business, I'll stay in.
Have you actually seen any kind of correlation between how often founders keep you updated about the company, like sending investor updates, and eventually really the success of the company? Do you see any relations, to that these communications impacting or reflecting the success?
I think so. I think if you so the biggest failure mode, I think, in interesting ideas and good opportunities, good founders, and failure or success, a lot of it has to do with their ability to find more funding when it's needed, to cross this chasm of being having early success to then really being able to scale up. So it's the ability to raise money. And if you've been really good in communicating with your shareholders, at least you've got them on your side, and it's going to be much easier, I think, to raise further funds if you've got your existing shareholder base being willing to put some extra money in. And I think it also speaks to the mentality of people, and investors like to be kept up to speed. So the next level of investors, unless it's a private equity firm, they play a different game. But the next level of the next level of investors like the same. So they like communicative founders who are willing not to just share some news when they need the funds, but they're willing to share news, good and bad, along the way. Yeah, I do think there's a correlation there.
Oh, it's good to know, and then as an encouragement for also for startups who are listening to us, really to send investor updates to their investors. It's definitely allowed to build a long relationships, more trust, and eventually probably more opportunities for a startup itself.
And it also gives investors the opportunity to help if help is needed.
Yeah, very, very good. So the question actually also about your would you go into capital intense business as an angel investor? What I mean, like let's say it's a biotech, bioengineering, super impactful, big market business, right? But eventually, do you feel your money make a difference for such capital intense businesses? And how often do you see actually such kind of capital intense businesses raising from angels?
Yeah. So there's quite a few things in that question. First of all, I do like to invest in businesses that generate knowledge, but also things, physical things. So I really like that combination. And some of the investments that I've made the things are actually pretty big and potentially quite capital intensive. At the time that I joined them, it's still in prototype, so there's not an enormous amount of capital that's required for the proof of concept. But when they scale up, they have to scale up these machines, and suddenly it becomes a very capital intensive business. But then there's a lot of choices about how you want to do that, whether you want to who is going to pay for these big machines. Do you do it through a licensing agreement, or are you able to find a lot of alternative sources of finance? I think there's a number of choices, and it depends on the strengths of the IP and the strengths of the proposition, uh, how much you can do with how little money. So I think it doesn't scare me off. But if the business is making something relatively simple and making it time and time again and that costs a lot of money. Obviously, that's not. I mean, that's not my type of business.
What kind of industries is your no-go?
Oh, no go. I don't like hospitality. I mean, I like hospitality, but I don't like to invest in it. I don't particularly. I don't understand business to consumer businesses. I have invested in them, and I've never really been successful with that. Um, I land on essentially a couple of areas, a little bit sort of investments that are green technology based, and mental health type of businesses. So those are the two businesses that I am a little bit biased towards, but I've got a lot of other things, other industries in my portfolio. But I wouldn't touch business to consumer anymore. That's what I stay away from.
Okay, it's quite understandable, and definitely, they require resources and good understanding of the not just your own audience, but mass market, right? And the marketing and a lot of moving parts. Every business has moving parts, but I kind of understand why the consumer businesses are totally different. Yeah, for decision making. Jan Paul, it was really amazing to have you on our podcasts. I hope our subscribers really got the inspiration and insights for their own investments. And one last piece of advice to anyone there who want to start the investment journey: where to go, how to start.
Yeah, don't do it if your purpose is if you're scared to lose money, if you want to keep having access to your well-deserved money. So don't do it if you're not prepared to lose it. And I think joining a syndicate would be my advice, because it's a good ground to learn from other people, and there's a good mix of experience there. Very experienced people, not so experienced people, people with a lot of industry knowledge. So I think it's a good opportunity to learn. And finally, I guess you have to be not greedy, especially not in the beginning. If this is a long journey, you can be very patient at the beginning. Don't try and go in there too hard. It's not particularly efficient.
Yeah, thanks a lot. Thanks to everyone who've been listening today. Subscribe to our podcast. We're looking forward to more of the angel investors and the VC investors who are joining us on this podcast. And I'm looking forward to see you soon. So
Thanks, Oriana. It was a pleasure.
thank you.